The following script was written, verified, and approved by compliance professionals at financial regulation courses. A high-yield bond is a corporate debt security rated below investment grade, specifically carrying a credit rating below BBB- on the Standard & Poor's and Fitch scales or below Baa3 on the Moody's scale. Historically emerging in the 1970s through academic research by Braddock Hickman and the pioneering market-making of Michael Milken at Drexel Burnham Lambert, these instruments provide long-term capital for growth-oriented companies. While these securities carry a greater probability of default, they offer significant yield premiums to compensate investors for the risk and the lower expected recovery in the event of default. Today, the high-yield market represents a multi-trillion-dollar asset class essential for corporate finance, private equity, and sophisticated fixed-income investment management strategies across global markets. The investment-grade boundary is the most consequential line in the fixed-income landscape, separating broad institutional access from the higher-risk speculative-grade universe. BBB-rated bonds occupy the lowest investment-grade tier, deemed to have adequate financial capacity. In contrast, BB-rated bonds represent the highest speculative rung, often called crossover bonds. Market participants must closely monitor fallen angels, securities originally issued as investment grade, but subsequently downgraded into the high-yield universe as an issuer's financial condition deteriorates. These often face forced selling pressure from institutional investors, restricted to investment-grade holdings, potentially creating buying opportunities for specialized high-yield managers who can absorb the supply and manage the risk. Conversely, rising stars are bonds originally issued at speculative grade that are upgraded to investment grade, expanding the eligible investor base and typically generating significant capital appreciation for holders. Quantitatively, speculative grade bonds average a 4 to 5% annual default rate in normal conditions. However, this figure can spike to 10% or higher during severe credit downturns. The credit spread represents total compensation for default, liquidity, and risk premiums. Understanding the ICEB of a high-yield index option-adjusted spread is vital for measuring these premiums. The liquidity premium component reflects higher transaction costs relative to treasuries, compensating investors for the difficulty of exiting positions quickly without significant adverse price impact during market stress. High-yield bond indentures utilize specific operational mechanics to manage higher risk profiles. Call provisions are almost universal, giving the issuer the right to redeem the bonds before maturity. These typically feature non-call periods lasting 3 to 5 years to protect investor yields from immediate refinancing should the issuer's credit improve or interest rates decline shortly after issuance. Payment in kind, or PIK toggles, allow highly leveraged issuers to pay interest with additional debt rather than cash during flow stress, effectively preserving capital at the cost of increasing liabilities. Investors must distinguish between senior secured bonds, backed by specific assets or collateral, and senior unsecured bonds, which represent the most common high-yield structure and rely on general creditworthiness. Secured status provides a priority claim in bankruptcy, leading to significantly higher historical recovery rates compared to unsecured holders who rank junior in the issuer's overall capital structure. Leveraged loans serve as a floating-rate alternative to high-yield bonds. Often arranged through CLOs or collateralized loan obligations, they distribute credit risk across diverse institutional investor tranches. Unlike fixed-rate bonds, these loans provide natural protection against rising interest rates by resetting periodically based on SOFR, plus a specified credit spread for the lender. Regulatory compliance requires strict adherence to bond covenants. These contractual restrictions limit additional debt incurrence and dividend payments to protect the interests of bondholders from unauthorized risk escalation. Firms must integrate high-yield monitoring into their written supervisory procedures, or WSPs, ensuring books and records retention cycles meet all applicable jurisdictional and regulatory standards. Supervisory controls also focus on managing liquidity risk, as lower trading volumes require careful monitoring of market depth to ensure orderly exits and accurate valuation of speculative assets. Effective duration management is often secondary to fundamental credit analysis in these portfolios, as spread volatility typically outweighs interest rate sensitivity as the primary driver of total return. Professionals must maintain clear oversight of these speculative instruments throughout the credit cycle to mitigate systemic risks and ensure that client portfolios remain within prescribed risk tolerances. In summary, high-yield bonds offer yield premiums, but require rigorous research and diversification, typically holding 30 to 50 distinct positions to manage idiosyncratic credit risk effectively across cycles. Remember the rating thresholds. Anything below BBB- or Baa3 is speculative. Successful investing requires deep awareness of these structural mechanics and regulatory boundaries. Visit www.financialregulationcourses.com for SIE and Series 7, preparation and professional development tools. Access exclusive technical resources to advance your finance career today.